Hey, so today we got Michael Burry again, who just publicly criticized Nvidia a few days ago. And his argument this time, Nvidia is the next RCA, the radio stock that fell 98% in the 1930s, even though radio kept growing for decades. And Nvidia just dropped their earnings literally just now with a $68 billion in quarterly revenue, beating every estimate on the street. So who's right? Look, if you're short on time and you don't want to listen to some random guy with a cat avatar break this down for like 12 minutes, here's what you need to know. Burry is not saying AI is fake, he's saying the stock is overpriced relative to what investors will actually earn. And historically, he's got a pattern on his side. But Nvidia's financials right now are so absurdly strong that the RCA comparison has some serious holes in it. The truth, as usual, is somewhere in the middle, and the details matter a lot. If that's enough for you, cool, go pet your cat, live your life. But if you want to actually understand why this debate matters for your money, stick around because I'm going to walk through both sides with real numbers, not vibes. Quick thing, if you find this useful, a like genuinely helps. I'm DataCat. This channel is about 7 months old. I'm a former analyst from a Fortune 50 company who traded spreadsheets and passive-aggressive emails for a mic and a green screen. I'm not selling you a course. I'm not selling you anything. I just like digging into data and explaining what I find. I'm honestly still kind of surprised anyone watches these, but here we are. Alright, let's get into it. So let's start with what actually happened yesterday. Nvidia reported their latest earnings, and the numbers were frankly kind of stupid. Revenue came in at over $68 billion for the quarter. They beat Wall Street expectations by almost $2 billion. Adjusted earnings per share, $1.62 versus the $1.53 consensus. Year-over-year revenue growth still absurdly high at 73%, and their data center segment alone did $62.3 billion, up 75% year-over-year. Now here's what really matters. Their guidance for next quarter, Q1 fiscal 2027, came in at $78 billion, plus or minus 2%. The street was expecting $72.6 billion. That's a $5.4 billion beat on guidance alone, which is not just a minor beat. And they're not even assuming any data center compute revenue from China in that outlook. None. Zero. I'm not going to lay out all the boring numbers one by one. Just know that other metrics such as their full-year revenue, net income, or free cash flow continue to be phenomenal. And they just returned $41.1 billion to shareholders over the fiscal year through buybacks. And yet, the stock barely moved. It's like the new norms nowadays. Up about 2 to 3% in after hours, then it faded to under 1% by the end of the call. And that honestly tells you everything about where we are. When a $4.8 trillion company beats every metric, guides way above consensus, and the stock shrugs, you're dealing with a market that has priced in perfection. The expectations are so high that even a blowout quarter is just, another day when your cat decides not to use the litter box. Okay, so let's rewind a bit. 3 days before this earnings report, Michael Burry posts on X, and he tags Nvidia directly. Here's what he said, and I'm paraphrasing slightly. In the 1920s, there was radio mania focused mostly on one stock, RCA. The stock fell peak to trough about 98% during the early 1930s, and yet radio's growth never slowed for many more decades. Even if you predicted a half-century of radio dominance, you would have lost money on RCA. Now this is important. Read that again carefully. He has changed the narrative, and he is not saying AI doesn't work this time. He is not saying Nvidia makes bad chips. He's making a very specific argument. A technology can be completely undeniably real and transformative, and you can still lose almost everything investing in the dominant company if you buy at the wrong price. RCA stock surged roughly 200-fold during the 1920s, 200 times your money. Then from its peak in September 1929 at $114.75, it crashed to $2.62.5 by May 1932, 98% gone. And radio kept growing. For decades. The technology was fine. The stock was not. But Burry goes deeper than just the RCA analogy. He's been building a broader case around capital expenditure sustainability. The hyperscalers, Amazon, Alphabet, Meta, Microsoft, are projected to spend $650 to $700 billion combined on AI infrastructure in 2026. And Burry's argument is basically this cannot continue without consequences. He points out that these companies are consuming all their free cash flow, borrowing in ways they historically haven't, potentially understating depreciation on their GPU fleets. We've kind of covered it before, but for those who are new here, this is a technical but really important point. So let me explain it again. When a company buys a GPU, they don't expense the full cost immediately. they spread it out over the expected useful life of the hardware. Right now, most hyperscalers are depreciating their GPUs over 4 to 6 years. Burry argues the real useful life is closer to 2.5 to 3 years because the pace of improvement in AI chips means older hardware becomes economically obsolete much faster. For now, let's just assume if he's right, and the useful life is closer to 2.5 years instead of 5, then these companies are understating their annual depreciation expense, which means they're overstating their earnings. Burry estimates cumulative earnings overstatement could average 32% between 2026 and 2028 across the major hyperscalers. He forecasts Amazon could generate negative free cash flow, negative 17 to negative 28 billion in 2026, and Alphabet's free cash flow could drop 90%. And then there's his electrification parallel, which I think is actually the most interesting one. In the late 1800s and early 1900s, electricity was clearly the future. The killer app, electric light, was obvious. Demand was enormous. Electricity production surged 280% between 1900 and 1910, and yet countless central power stations went bankrupt. The panics of 1893 and 1907 wiped out many companies. Even Westinghouse Electric filed for bankruptcy. Edison himself eventually lost interest. The technology was real, the investment returns were not. Essentially, it's the crowded trades or crowded thinking that kills your investment. Okay, so that's the bear case. And let's be fair, it's well constructed. Burry is not some random person yelling on the internet, but I still think there are some fundamental differences between Nvidia today and RCA in 1929 that you really need to understand. First, profitability. RCA in the 1920s was largely a speculative bet on future potential. The stock went up 200-fold on hope. Nvidia is generating over $100 billion in net income, 35 billion in quarterly free cash flow. This is not a company trading on dreams, it is, to put it bluntly, a money printer, a very large, very efficient money printer, like a cat that somehow learned to counterfeit currency, except it's legal and the SEC is fine with it. Second, revenue is still accelerating right now, not decelerating, with guidance implying 77% growth next quarter. RCA's stock peaked as growth was slowing down. Meanwhile, Nvidia's growth is speeding up. That's a meaningful difference. Third, margins are expanding. In a typical late cycle scenario, you see margin compression as competition increases and pricing power fades. Nvidia is currently showing the opposite. Fourth, and this is the one that doesn't get talked about enough, the customer base is diversifying. While hyperscalers are still over 50% of data center revenue, the fastest growing segment is what Nvidia calls the rest of data center customers. AI startups, enterprises, sovereign governments building their own AI infrastructure. Revenue is spreading out, not concentrating. That matters because it reduces the risk of a single customer or customer group pulling back. Fifth, the moat. RCA was essentially a hardware assembler. Nvidia has CUDA, essentially a software ecosystem that millions of developers are trained on. They have NVLink for chip-to-chip networking. They have Spectrum-X for data center networking. Their networking revenue alone hit almost 11 billion in Q4, which was a 263% increase year over year. That's the proof of ecosystem lock-in. And RCA had nothing like this. Also, Jensen Huang addressed the CapEx sustainability question directly on the earnings call. He said, and I'm quoting here, "I am confident in their cash flow growing." And the reason for that is very simple. We have now seen the inflection of agentic AI and the usefulness of agents across the world. In this new world of AI, compute is revenues. Without compute, there's no way to generate tokens. Without tokens, there's no way to grow revenues. His argument is that AI infrastructure spending isn't speculative CapEx. It's revenue-generating investment. Every dollar spent on compute translates to token generation, which translates to customer revenue. Whether you buy that framing or not, it's at least a testable claim. And right now the numbers support it. So here's where I land on this. And I want to be honest with you because I think you deserve a straight answer, not cheerleading for either side. Burry has a point on three things. 1. Concentration risk is real. Over 91% of Nvidia's revenue comes from data center. If hyperscaler CapEx cycles turn, the impact would be severe, which also implies we are currently very vulnerable to any black swan event. 2. The depreciation debate matters. If GPU useful lives are shorter than what companies are booking, there is a meaningful earnings overstatement risk across the entire tech sector. But as discussed in previous videos, system rack life cycles typically last longer than a single chip, and it's well justified. 3. Historical precedent is sobering. Every single major technology infrastructure build-out, railroads, electricity, telecom, fiber.com, has involved a period of overinvestment followed by a painful correction. Every single one. even when the technology was completely transformative. But the RCA analogy specifically breaks down in important ways. RCA was speculative. Nvidia is profitable at a scale that's almost hard to comprehend. AI monetization is already happening through inference tokens, coding agents, enterprise automation. This isn't 1925 radio where everyone's guessing about future revenue. The revenue is here, it's enormous, and it's growing. Nvidia trades at roughly 40 times earnings. That's expensive, sure. But RCA's 200-fold run-up was on minimal actual earnings. 40 times earnings for a company growing revenue at 70+% with 75% gross margins is a very different conversation than a speculative stock trading at hundreds of times whatever earnings it might eventually produce. The real risk, in my view, isn't that Nvidia is RCA. It's that Nvidia is so good, so dominant, so profitable, that any slowdown, even from incredible to merely very good, could cause a significant repricing. When you're a $4.8 trillion company, the math gets harder every quarter. You need bigger and bigger absolute dollar increases just to maintain the same growth rate. At some point, the law of large numbers catches up with everyone. Even cats eventually run out of mice. The question isn't whether AI is real. It is. The question isn't whether Nvidia makes the best chips. They do. The question is whether the current stock price already reflects all of that and then some. And that's a question each person has to answer for themselves based on their own time horizon and risk tolerance. That's where I'll leave it. I try to give you both sides with actual numbers instead of just opinions because I think that's what's actually useful. If you made it this far, I genuinely appreciate it. Like I said, I'm DataCat. The channel's only about 7 months old. I'm still figuring out the lighting situation, as you can probably tell, but I'm trying to put out stuff that's actually worth your time. If this was helpful, a like and subscribe would mean a lot. No course, no Discord, no paid anything. Just a former corporate analyst and his cat trying to make sense of markets. DataCat out, and I'll see you in the next one.